Hello again, this is Clip 2. So let's talk about the announcement, news, and efficient markets. Announcement and news are very important components for the stock market. The price should reflect this announcement and news. And this announcement news has two different types. One is the expected one, the other is surprise. And the expected one, basically, the price reflects this expected one already. However, because it's surprise one cannot be reflected by prices. So the surprise component affects the stock price. So the efficient market results from investors trading on expected news. It means that the easier it is to trade on surprise. So everybody just see the surprise and start to trade. If trading is easier, then market gets more efficient. So here, total return has expected part and unexpected part. And this unexpected part actually relates to the risk, right? And this unexpected part has two different types. One is systematic portion and the other is unsystematic portion. We're going to learn. So total return, three components again. One, expected return. Two, systematic portion. And three, unsystematic portion. And we're going to learn what's the difference between systematic and unsystematic portion. So what is the systematic risk? Systematic risk is the factors that affect a large number of assets. So many assets. Like market type, industry type. So not the single company stuff. It's called non-diversifiable risk because we cannot diversify away. We have to take it. Also called market risk because this is risk in market. So if you are a market participant, then you have to take it. There's a number of examples here. So macroeconomic factors is typical example. Change in GDP, inflation, interest rate, and any type of the news that affect the market itself, like political changes, Donald Trump. That's the market risk. You cannot control. Then that's the market risk, systematic risk, and non-diversifiable risk. Now the second part is the unsystematic portion of the risk. Unsystematic risk, also called a diversifiable risk because you can diversify it away. It's risk factors that affect a limited number of assets, usually one company or just a small number of companies. It may be eliminated by combining assets into portfolio. So if you add more assets, then you can eliminate this risk. This is also called unique risk or asset-specific risk, also company-specific risk. So firm risk. Labor strike, part shortage, and like a sudden death of CEO, any type of news that affects this very specific company will be the unsystematic risk. So what's the principles of diversification? Diversification can substantially reduce the risk without an equivalent reduction in expected returns that we saw in previous examples, right? If you see the Excel spreadsheet again, the portfolio expected return, the standard deviation is less than the weighted average of each standard deviation, which means that you can reduce the risk, but you do not lose any returns. It's because it's basically there's offset of worse than expected return from one asset by better than expected return from another. So they're offsetting each other. That's why we can actually reduce the risk. And the minimum level of the risk. So if you really form a well-diversified portfolio, so you reduce most of the risk that you can diversify away, but there's a minimum level of the risk you have to take, which is the market risk. Systematic portion of the risk. That's the minimum level of the risk you cannot diversify away. So this is a table to show the number of stocks in portfolio versus the average standard deviation. And this is ratio of the portfolio standard deviation to the standard deviation of the single stock. And if you look at here, so if you add one more asset from 1 to 2, then annual average standard deviation decreased by about 12% points. It's a lot, right? 2 to 4, about 8. 4 to 6, about 3. No, it keep decreases, right? It keep decreases. But as you saw, the degree of decrease, the speed of decrease actually also decreased too. So the marginal effect is negative. So from 1 to 2 is a lot, but 10 to 11 is not that much. 900 to 1000 is very minimal. So as more stock added, each new stock has a smaller risk, reducing its impact. And portfolio standard deviation falls very slowly after 40 stocks are included. So forming well-diversified portfolio, see, compare. This is about 0.4, right? 0.4. You can reduce more than half of the risk actually away, which is great. And this is a graphic, so this is convex curve, right? And this is actually the market risk. And if you add like the 40 stock, most diversifiable risks go away. So again, the total risk has two functions: unsystematic and unsystematic. And standard deviation actually measure both of them, right? But for well-diversified portfolio now, this is ignorable because we will diversify away. So this portion of the risk is the important one. This is the risk that we actually have to take. So the total risk of the well-diversified portfolio is essentially same as the systematic portion of the risk. So again, risk-return trade-off. There is a reward for bearing risk, but as you saw, there's no reward for bearing risk unnecessarily. So wrong choice. You have to diversify away that unnecessary risk. So the expected return on an asset depends only on asset systematic risk. It's not related to unsystematic portion of the risk in efficient market. So how to find the level of the market risk? We can actually compare with the level of the risk in the market, which is called the beta coefficient. And beta coefficient can be calculated by the correlation coefficients and the covariance, which is another measures. And it's basically the measures the stock's volatility relative to market. Okay. So if beta equals to 1, stock has average risk. The risk level is market portfolio. Okay. If beta is greater than 1, then it's riskier than market. If beta is less than 1, it's less risky than market. So definition of the beta is, if beta is 1, then the level of the risk is same as the market risk. Most stocks have beta in the range of 0.5 to 1.5. So beta of the market is always just 1. And beta of the T-bill, which is risk-free asset, is 0 because there's no risk. So this is the selected company's beta from Home Depot to Citigroup. Citigroup beta in 2009 2.4 because that time is crisis period. So if you see the beta of Citigroup these days, probably a little lower. And Home Depot, very safe company, but you can also expect less returns. So, how to find the expected return using the beta? There's some relation between the beta, which is the level of the systematic portion of the risk, and the expected return. Before looking at that, we have to know the concept called the risk premium, right? So the risk premium that we saw in chapter 10 is the difference between the expected return on certain asset and the risk-free rate, right? And the higher the beta, so if beta is higher, the risk is higher, right? It means that if you have high beta, you have to expect high risk premium. So this is a graph in equilibrium. Okay. So this is asset expected returns, and this is asset beta. The relation should be linear because in equilibrium, because this is fair. If you have like this curve, right, then the degree of the taking risk and taking more risk or taking less risk relative to the amount of the return you receive, the reward, is different actually at all points actually. So it's not equilibrium. For the linear line, this is fair. Everybody happy. So first of all, this should be fair. It means that the slope should be the same. Okay. So if you pick one asset, say this is the expected return on I, and this is the beta of I. Okay. In equilibrium, the slope of here should be same as here, market. So the slope here is expected return on I minus risk premium divided by beta of I equals to, say, the market here, the expected return on market minus risk-free rate divided by beta of market in equilibrium. That's the equilibrium condition. Okay, and this is also reward to risk ratio, and the reward to risk ratio should be the same all points in equilibrium. It should be straight line. And this one. So in equilibrium, all assets portfolio must have the same reward to risk ratio. Each ratio must equal the reward to risk ratio for the market. So this should be hold. If this holds, see what happens. What happened is, now, because expected return on A minus risk-free rate divided by beta of A equals to expected return on market minus risk-free rate minus beta of N and beta of market. This is 1, right? Because this is 1, you can solve expected return on A minus risk-free rate divided by beta of A equals to simply market risk premium, right? And then this can be now expected return on A equals to actually the risk premium equals to beta of A times expected return on market minus risk-free rate. So we have this one actually. The expected return on I equals to the asset equals to risk-free rate plus market risk premium times the beta, which is called CAPM, capital asset pricing model. So we can find the expected return versus the beta relations. This is all given numbers. Risk premium usually is the T-bill rate, and the market expected return is usually S&P 500 returns. Okay. So if you have this information, then you can actually calculate the expected return on asset I. So capital asset pricing model show the relation between the expected return on certain asset and the risk level, the systematic portion of the risk of that asset, which is beta. If the beta is known, CAPM can be used to determine its expected returns. Okay, this is the example. You can find the required return here from the CAPM, actually, using these numbers. You can practice. So what factors affect the required returns? Number one, the risk-free rate. The risk-free rate is the time value. Because you don't take any risk, this is time value. The second one is the market risk premium. Is the reward for bearing the systematic portion of the risk, right? And then this is the degree of the systematic, the amount of the systematic risk. So if beta high, then you expect return high. How to find the portfolio beta? Now, because portfolio beta is simply you eliminate all the diversifiable risk. The beta is only systematic portion, so undiversifiable. It means that the portfolio beta is simply the weighted average of the beta. You can reduce the beta because the beta is the level of the risk that you should take. Okay, all right. For covariance, the correlations we're gonna do in class actually, so you're not gonna get this problem in assignments because I have to show some mathematical steps. Okay, so that's the end of the chapter 11. And see you in class.